Hello, everyone. This is Kathy McBreen of the Spectrum Group. Welcome to our November webinar regarding our Investor Confidence Index. And today we're also going to talk a little bit about one of our new reports that really delved deeply into the attitudes of professionals. Today I'm here with George Walper, our president, and I'm going to turn it over to George to talk a little bit about our monthly index numbers.
Thank you, Kathy, and hello, everyone. We will talk about what wealthy investors think about last month and what they also think about going forward. And then, as Kathy said, we will spend some time with our professional profile research, which professionals being doctors, lawyers, and accountants. And then we always touch base on this month's high net worth newsletter. This past month is very interesting for lots of different factors. We'll go through that in a little bit of perspective as we go through that. What's interesting is, generally speaking, both indices, the Millionaire Confidence Index, which is a reminder is of wealthy investors over $1 million, and the overall affluent, which is wealthy investors over $500,000, dropped a little bit in each category. We'll talk about that, but it's very mixed. We've always taken a look at how millionaires compare to the wealth market overall. And typically, as you can see from this historical chart, especially the last year, the light blue chart on the top is millionaires. The affluent is the group below. We've always seen a pretty similar spread month to month. But let's look at what happened this past month. The overall affluent dropped significantly more than the millionaires. And what we see, and we're going to see that throughout the next couple of pages as we look at different preferences, is that the not as wealthy Americans are starting to feel concerned about a number of factors. And so you see that the spread between millionaires and non-millionaires is wide. It's essentially the widest as it's been all year, with the exception of going back to the month of April, when it was 10 points. And then we see what happens the next month, which is the millionaire plummeted and the overall affluent plummeted as well. So the question for all of us is, are the factors out there in the market, in the political world, in the world in general, such that this is now beginning to be a downturn, especially for the non-millionaires? It's kind of a very interesting factor. Now, saying that, and having said that, you would think that a number of factors, especially about how the wealthy look at their outlook for the next month or so, essentially flat and still remains at the highest point throughout the year. So you have a drop, but yet looking forward, people still remain somewhat optimistic. And that's why this actually is a fairly interesting month, because of all different types of signals. Their overall outlook, a slight increase, as I said, from last month and from a year ago, pretty significant. A year ago, as a reminder, was just before the election. Household income, however, has dropped a little bit in terms of what people think, as does their overall perception of either the company they own or their employer's health has dropped, and everything else has remained somewhat flat. So you see whenever we see red and green or up and down or significant shifts, you start to think about what this means going forward. A question that we asked for the first time back in July, and we repeated again here in October, was, so, okay, investors, you think about all these different factors in your life. What are you going to change in the next 12 months, either change or invest or action plan? And you'll see that the greatest response was no change. And then you see the second greatest, which was essentially the same as last time, which was change investment strategies. That also is interesting, which means even though you're starting to see a little bit of concern going forward, you're not seeing an overreaction in terms of getting out of the market. Paying down debt is always a factor. Reducing spending, maybe just change spending, that also could mean increased spending. But essentially, folks are still feeling pretty good. Things were down a little bit, but they're still somewhat thinking about going forward. Now we look at the same thing here, comparing the millionaires to the affluent as a whole, and you do see that millionaires, even though I've said everything they've said, they're comfortable, they're 26% say they may alter their investment strategies compared to the non-millionaires or the affluent as a whole. That's not that significant, but it is interesting about the differences. And then we look at their investment preferences. And this again gives you some interesting mixed results, where equities still remain pretty positive in terms of this month, both equities, individual stocks, and then stock mutual funds. Fixed income, however, you saw an increase from September to August for individual bonds, and the same thing for bond mutual funds. So you start to see a little bit more conservative perspective there. And the same thing when you look at cash, you see an increase in cash September to August. None of these anywhere near the all-time high, with the exception of, well, I was going to say the exception of stock mutual funds, but that really is not as high as stock mutual funds were back in February 2004. So you start to see some very interesting mixed results. We hope that this doesn't portray what's going forward for the next month or two. However, you still have the equity markets at an all-time high. You still have tax reform that's out there in a positive light. It hasn't been shut down yet. And you saw that, in particular, interest rates are still going to be where they are, with a potential increase at the end of the year. So you have lots of signs that are confusing to investors, but trending positive with a little bit of concern. So we're looking forward to what happens next month. So as Kathy and I both said in the beginning, we're going to shift to one of our more recent large dedicated studies with professionals. And I'll turn it over to Kathy to give you insights on that.
Thank you, George. Over the summertime, we did online research with several hundred doctors, lawyers, and accountants, and we also did online focus groups with each of those different groups in different parts of the country. The goal of the research was really to try to understand how these three different professional groups, doctors, lawyers, and accountants, make decisions about their investments, how they rely upon their advisors. We know that these are really an attractive group that our clients tend to focus on to try to, as prospects and as clients. So what we wanted to do was to focus on what is unique about each of these different groups and how our clients could attract and service these different types of professionals better. One of the first things, and I don't think it will be surprising to any of you, is we asked doctors, lawyers, and accountants how they defined their degree of knowledge about financial services and products. And it's not surprising that you will find that, so on the bottom is I'm very knowledgeable is the blue color, and I'm fairly knowledgeable is the red color. The green color shows people who are a little bit less knowledgeable and willing to acknowledge that they could listen to somebody and understand something. And then those who feel they know nothing are always at the top. So as you can see, doctors and accountants are very, very knowledgeable according to themselves. But lawyers and accountants, you can see, have the biggest chunks of blue, where they both feel that they are very knowledgeable about financial products and services and investments. And if you compare those two groups to the group on the right, which is all other occupations from our ongoing research that we do with investors, you can see that all three of these segments think fairly highly of their own investment expertise. And if you look at doctors, even though they're not quite as likely to say they're very knowledgeable, they're more likely to say they're fairly knowledgeable. So overall, they're one of the groups that's the highest about confidence regarding what they think they're discussing regarding financial issues. So the learning from this is when one of you, your advisors or yourself, is talking to one of these individuals, you need to make the presumption that they think that they're very knowledgeable about this business, whether they are or not. Unlike other households, many of these professionals are not very worried about being able to retire when I want to. There are a lot of factors that could play into that. One of them is simply that in a lot of cases, doctors and lawyers, and even accountants in particular, sometimes are sort of self-employed. I mean, they may work for a larger group or network, but they really don't work for a corporation where there's probably a given retirement date. Some big law firms have that, but not all of them. So in a lot of cases, they are going to be able to retire whenever they want to, and they're really going to be able to retire when they feel like they're financially ready. Because they're generally high income earners, a lot of them feel like they're probably saving as much as they can. We don't know if that's true or not. And a lot of times we find a little panic when they're about to retire. But for the most case, they all feel that they're fairly wealthy. They'll be able to have enough money for retirement, and they may be able to choose the date when they actually want to retire. You can see on the right-hand side, only accountants expressed concern about being forced into retirement before they're ready. That may be because they're a little more knowledgeable about the amount of money they actually have to put aside. One of the interesting issues about these different groups of professionals is their retirement accounts. And I say that for a lot of different reasons. One of them is that, a doctor or a lawyer or even an accountant, because of the unique way that their practices might be established, they may or may not be part of an employer-sponsored plan. They may or may not be part of a plan that's made up of a group of doctors. They may be eligible for benefits through a hospital that they may work for if they're a doctor. So they have pretty complicated retirement scenarios, and we tried to illustrate some of this. As you can see, only a little more than half of doctors and accountants are part of a larger employer-sponsored retirement plan. And you don't know if that's part of a plan that's for a larger organization they may work for, or if it's a plan that's sponsored by their own practice. That compares to 65% of people in other occupations. In contrast, lawyers are much more likely, like the other occupations, to have an employer-sponsored plan. We also asked about contributory IRAs, and that's because that's one of the vehicles, although there are others as well, including executive comp kinds of plans, that these types of professionals are able to contribute to. You can see lawyers are the most likely to have a contributory IRA of some type. And in all the cases except for accountants, they are higher than other occupations. So both lawyers and doctors are more likely to have a contributory IRA. For the most part, these individuals are not worried about depleting their retirement funds too early, but that's similar to other occupations. So lawyers at a 19 on a scale from 0 to 100, and doctors at 22 are just below other occupations, and accountants are a little more likely to be worried about depleting their retirement funds too early. Again, it may be the reality that they have of being able to actually crunch numbers better than some of the rest of us. Do these people use an advisor? As you can see, 85% of lawyers say that they use a financial advisor of some type, compared to 79% of doctors and accountants, and all of their occupations are at 80%. So pretty much similar to all of the other types of investors that you have. They may be a little different to deal with. You may find that they ask you different types of questions depending upon their profession. And again, lawyers probably think they know a lot more than you. Doctors may think that they know about the same amount as you. But either way, these are very knowledgeable or fairly knowledgeable about their own industries or their own expertise. So therefore, their expectations are that your expertise as a financial advisor is just as high as theirs. How much do they depend upon their advisor? We break our analysis into 4 different groups, and this is self-defined. So as we said in this slide before, these people may actually use a financial advisor, but for the most part, this is their perception of how much they depend upon their advisor. So on the left-hand side, you will see the self-directed. So these are investors that they're not truly self-directed. They may still have an advisor, but for their own opinion, they believe that they make most of their decisions on their own. Accountants are the most likely to feel that way. All other occupations are at 32%. Lawyers a little bit more self-directed, and doctors a little less than the general population. Event-driven investors are those that go to an advisor when they come upon what we would call a life event, meaning they're getting married, they're getting divorced, they're sending a kid to college, someone died, or they're about to retire. Those are the times when these types of individuals would go to an advisor. And as you can see, it's pretty consistent with the accountants being the lowest group. Advisor-assisted investors are those that rely upon an advisor. They will discuss issues with their advisor, but they feel that they make the decision themselves. And that's pretty consistently at just over 20% of these professionals. And the lowest number of professionals consider themselves to be dependent upon their financial advisor. And that's pretty consistent as well, with accountants being the least likely to be advisor dependent. So do these professionals worry about fees? For the most part, we know that most of their fees are pretty substantial. Lawyers are the only ones that say that they are relatively unconcerned about fees as long as their assets are growing. Coming from a family of lawyers, I can tell you that I believe that in a lot of cases, many of these lawyers who are not in the financial services types of professions, many of these lawyers don't really understand the fees that are charged within the financial services industry, despite the fact that they feel that they're very knowledgeable. So I'm not surprised that most of them say they're relatively unconcerned because they don't really want to take the time to try to understand how many of these fees are charged. Doctors, again, they probably don't really understand the fees, but again, they're a little more likely to say they're worried about the fees. Accountants, you can imagine, are a little more worried about the fees than others. And then about 30% of all occupations, a little more than 30%, are relatively unconcerned about fees as long as they feel their assets are growing. So I'm going to turn it back to George to thank you for listening to this, and I'm going to turn it back to George to tell you a little bit about our high net worth newsletter.
Well, thank you, Kathy. Professionals are a key wealth segment for advisors and providers to focus on. So we did particularly find that research to be helpful to advisors. The index and other key highlights from our research are available each month in our High Net Worth and Insights newsletter, which is designed for advisors who manage wealthy investors. This particular month, we do a little bit more insights around the professional series that Kathy mentioned about when lawyers talk to advisors. We also discussed one of our recent research with wealthy women investors and did some interesting questions around does cold calling work in terms of trying to generate new business advisors, etc. And then touch based on some of our mobile technology research. And then the rest of that looks into what's happening with our index and investment futures in more detail. So if you have any questions about this or anything else that Spectrem does, feel free to reach out to us at spectrem.com, or our phone is 224-544-5350. Thank you.